Wow, 200 people to hear about custody. I never thought I'd see the day. But hello, and thank you for joining us for this discussion, looking at the role of the custodian and the wider ecosystem for institutional clients investing in digital assets. As Jason said, I'm John Watkins, the managing editor of Global Custodian, the leading title in the traditional custody space. And I'm delighted to be joined by a very, very impressive group of industry experts to examine what institutional clients need to consider in the safekeeping of digital assets and interacting with the wider ecosystem. Now, this is normally where I'd give a bit of background on what we're talking about today, but if you don't know, then you might be in the wrong place, either that or you've been living under a rock for the past few weeks. But in all seriousness, there's news, views, and developments occurring on an hourly basis on this, so there's no point trying to update you. Plus, I think the first panel just gave a brilliant background, and I enjoyed some of the hot takes during that. Very insightful and entertaining, even if you did encroach on our custody theme a little bit. But look, FTX has sparked all manner of discussions and debates, so I think to drill down into custody matters for institutional investors is a really critical and timely theme. So I have to extend my thanks to Bosonic for pulling this together, especially at such a short notice. As a publication that tends to take months putting these webinars together, I really take my hat off to you for getting such brilliant speakers at short notice. So without further ado, should we do some introductions to those great speakers? And Rajiv, if we can start with you, please.
Yeah, thanks. And I'm based in Singapore, so it's still an interesting topic to sort of have this conversation at this point in time. I'm from HSBC Security Services, lead our digital asset product proposition.
Thanks. And Giorgia?
Yeah, hi, John, everybody. For having me today. So my name is Giorgia. I'm head of custody at HexTrust, a leading custodian, a digital asset custodian for institutions based out of Hong Kong. We now present in six countries, licenses in almost all 6 countries, and over 200 institutional clients.
Thank you. And Tahina?
Hi, everyone. I'm Tuhina, CEO, co-founder of Propine. We're the first custodian licensed in Singapore. We hold a capital market services license, which allows us to custody digital securities, crypto, and fiat, all on a seamless platform, which allows our customers to store, manage, deploy, and track the digital assets. Thank you. Based in Singapore, too.
Thank you. And Phil? Phil, you might be on mute because I can't see you popping up on my screen.
Sorry about that. Yeah, my name's Philip Annette. I head up business development globally for JP Morgan Coin, and I'm also based out of Singapore.
Excellent. Thank you. Some late nights for you APAC-based panelists. But Vincent, over to you as well.
Hi, thank you for having me today. I'm Vincent Chalk, CEO of First Digital Trust, registered trust company out of Hong Kong, specializing mostly in crypto custody, but more in traditional asset class that we've been dealing with traditionally under the retirement pension plan previously.
Brilliant, thank you. Really good mix of panelists. And look, we've got a lot to get through, but if you do want to throw some questions into the chat, do so. We'll try to get to them at the end or during the conversation if it relates to what we're talking about. But why don't we start with some fundamentals? And this is by no means is meant to be patronizing, but Tahina, if I could ask you first, do investors in the digital asset space truly understand what a custodian does and the purpose of why they're there in this context?
Thanks for the question, John. In fact, today morning, Rajiv and me were at a conference, and this was one of the key conversations that happened there where everyone was talking about, hey, custody is very important and it's beginning to be recognized as such. But I think what was missing in what we should be talking more about is what does custody even mean, right? So in most conversations about custody, people focus on one aspect, which is how to store and manage your digital assets, which then converts down to talking about how do you manage your keys. Really, that's really been the crux of all conversation. In certain cases, now people have started to talk about, can we talk about the operational frameworks? How do you manage those keys, right? But I think that's only part of the conversation. When you talk about a digital custody solution that is institutional in nature, then I think there are several other wrappers that will come into play. So the first wrapper on top of this is going to be reliability and scalability of solution. Now that again is at a tech level, right? So all of this that we've talked about thus far has been mostly in the tech domain. Now let's talk about other things. The first thing that we should be thinking about is compliance, right? KYC, KYE, AML, travel rule, and whatnot that goes with it. And then there is an element of fiduciary duty. I think that's an element that's completely missing when we talk about digital asset custody. And it is mostly regulatorily driven. So unlicensed custodians will almost never have a concept of fiduciary duty, either contractually or from a regulatory side of things, of course. Then comes the legal frameworks. So you should be talking about what kind of legal frameworks are we signing on with our counterparties? What's the fine print there? Stuff like, can we rehypothecate your client assets or not? And then there is the statutory capital requirements, again, a requirement that comes in from the regulatory side of things. Then the risk and governance frameworks need to be talked about. Asset servicing is a key part of what an institutional digital asset custody solution should be able to offer their clients. Reporting, tracking of assets, accounting, audit, taxation, you should be able to talk about all of those things. So as you will see, we've been talking about a very core and important aspect, but still a very small part of the entire story when we should be thinking about custody solutions. Sorry, I think I'm going to stop here now.
No, great first answer. And anyone got anything to add on that?
And that's basically where the focus ought to be, right? So, I mean, I do think that in the heat of the moment, convenience sort of trumped everything that Tuhina talked about. But if you look at any large institutional investors getting into traditional assets, those are the kind of things that you would do as part of the due diligence in deciding where do you want to put your assets. And there are other kind of relationships that you would have if you want to basically put in your assets with your broker, right? That's a completely different agreement versus if you want to engage a traditional custodian, right? So these are the two things I think large institutional investors are always aware of. But I do think that the new asset class brought in probably a new set of investors, institutional or not, but and also, right, so the ease of doing things meant that I think some of these aspects were overlooked.
May I jump in here? I think Tahina really just gave a brilliant and very comprehensive overview of what a digital asset custodian for institutions really should be doing. Maybe one thing I would add that from a product perspective, I think it's very important that all let's say the use cases of these institutional clients are fully understood and translated into actual just functionalities, so that they can feel confident and familiar with handling these assets, which are really a new space for them. But they find the familiarity of workflows, or once again, we talked earlier about segregation of duties. How can they bring that onto a platform, right? So we are talking about obviously UX. We're talking about just pure product mastery in here to actually instill that confidence that they can just preserve their their regular best practices, just handling different type of assets.
Maybe I'll jump in here as well. I think the biggest challenge for a qualified custodian is also trying to integrate the real traditional side of custody with the speed of the digital asset space. We know that institutionals in the digital asset space are used to technology moving at lightning speed, but for us as a custodian, we have to consider our fiduciary responsibility, as Tuhina mentioned. One is we are also in Hong Kong and most other proper jurisdiction it's the custodians criminally liable for non-proper KYC and AML duties, conducting, improper AML and KYC, as well as we have to look at some other objectives that we have. Is one, we have to look at what is the reporting obligation for a custodian for their clients in CRS, for example, automatic exchange of information, different regulation. Are we also taking in crypto or any other asset from blacklisted countries, or something that's been sort of shielded and redirected into other countries? We have to really dig deeper into that for us to realize how we can actually perform proper custodian services for institutional clients.
Excellent. Phil, I don't know if you had anything to add, but I've got some questions coming in from the audience as well, which some of them relate to what we're talking about.
I mean, I'll be brief. I'm not representing a custodian here, so it's not my specialist area. But I think the last panel summed it up, and I think it's true for everybody on this panel that institutions wish to deal with trusted and credible partners across the value chain, and that's what everyone's looking for. So I think that's kind of the summary of what we're discussing, I think.
Yeah. Well, so someone's asked a question, and it kind of flips what I asked about, investors understanding the custodian's role, and it says, do custodians really understand crypto assets? And I don't know if they're referring to more retail focused or traditional incumbents. So it says, do custodians really understand crypto assets? Do we need to have more people with direct experience of mining cryptos and coding? Anyone want to address that?
Yeah, maybe I'll jump in on that. Since I've been really a trustee for multiple different asset classes in the past with a previous trust company that I also ran. So to me, crypto is a virtual property, is a commodity. It's another asset class, and how we treat it in a lot of different jurisdictions. We have different treatments of crypto. Some is security, some is currency, some is considered property, some is so. We have been dealing with those asset classes for years previous to actually identifying it as a cryptocurrency. So yes, that's the reason why I think the First Digital sort of have a slight advantage in the crypto custody space, because we look beyond just the technology. We really look, is that a security? Is that treated like a currency? What are those values? What is, again, those obligations as a custodian do we have?
Yeah.
I'd like to continue here. I would say absolutely we must understand what asset we're working with. Also because the technology side of blockchain and crypto evolved so fast. So, only a few years back, we didn't know what DeFi was. Now DeFi exists, well, now for a few years now, but institutional clients come to us asking, what is DeFi? How can I access DeFi? What can I do? How can I do it from a safe space? This year is metaverse. We do have institutional clients coming to us and say, hey, how can I own digital land? Where do I store it? How do you use it? How do I connect to Web3? So it's imperative that we know what we're working with as a custodian. So I would say a really great mix of, technology, experience from traditional finance, as well as, really a stack of people looking into constantly every day what is happening in the industry, because again, it's moving too fast, and institutional clients are also quickly adapting and demanding that we are as fast as the industry. So I would say it's mandatory that we are on top of digital assets.
Mm-hmm. Okay, well, thanks both for answering that. Can we talk about self-custody? And Giorgia, maybe I could stay with you for this. Firstly, perhaps a quick explanation of what that means, but secondly, can we all kind of discuss whether this is really a long-term option for institutional investors or not?
Yes, absolutely. Let me tie these together with what happened with FTX, right? Well, what I have observed is that after the recent events, there was really a lot of communication happening on social media around take your crypto back, right? Not your key, not your Bitcoin. So over to what self-custody means. It simply means that you are the safekeeper of the private key of your wallet, meaning that you are solely responsible to safekeep that piece of information that would allow anybody to access your funds. So I hope that the way I frame this, showcases the importance of holding that piece of information, right? So this is self-custody. So does it sound the way I explained it? Does it sound something that an institutional, client should be doing? I don't think so, right? But I guess for retailers, maybe, maybe they're really sore, maybe they really lost a lot of trust. I would say trust has been lost across the full spectrum, right? From retailers to institutional clients, of course. But maybe, they think, okay, I'm going to go and buy a hardware wallet, right? That's fine. But once again, is that a long-term solution for an institutional client? I don't think so. And this is why I believe that you know, in 2023 and hopefully all the years to come are going to be golden years for custodians, because I think finally, from being possibly the least sexy part of the digital asset space, you know, custodians were the ones where you park your assets, you know, and leave them there, right? Now we're finally becoming relevant, right? And I would say righteously so.
Yeah. Okay.
May I add a little bit here? So, okay, so in like Giorgia said, right? Like right now, self-custody is being pandered as this, you know, panacea for world peace, essentially. And you hear, like what Giorgia said, you know, not your keys, not your assets, or, you know, be your own bank or self-sovereignty. What I definitely want to talk about is that these words or these phrases are either badly abused, badly misused, or at least highly used out of context, right? So self-custody has to be understood in the sense like, why is it considered so important, or what is the draw here? The biggest draw here is the sense of control. And control is the key, and the freedom that comes with it, and that's fantastic, right? The problem is that, and Giorgia said that as well, there is responsibility and accountability that comes on top of that, right? Now, there's a cost to that freedom, there's a cost to that control that you are seeking, and I'm not sure if everyone really understands that cost, or for that matter, is willing to pay for that cost. And then the second part is, so against this pro of freedom and control, what else are the cons of it, right? So some of the cons could be, one, they are clunky and they're difficult to use, right? Especially if you're thinking about a cold storage solution, you're going to be handling a physical asset, a physical token, or like a ledger or trezor or something like that in your hand around. Not very easy to use, right? And then you need constant upgrades for it that you are yourself responsible for. It massively increases the possibility of an accidental loss or digital fraud. On top of that, there is, there's always, against this freedom and control, that benefit that you get, you're giving up massively, either in the form of security or in the form of convenience, right? And there's that trade-off can be pretty massive there. It's necessarily not fast enough. And there's still AML obligations that people can't be absolved of. And then there's another point that is, again, not talked well enough about, that is the agency risk. So self-custody may be appropriate when you are managing your own assets. But as soon as the manager of an asset is different from the ultimate beneficial owner, the agency risk comes into play, and self-custody automatically should be taken out of the picture as an option in the first place.
I think
So John, go ahead, Vincent, and maybe I'll add a few points there.
Yeah, I just wanted to touch on self-custody. I think that's really important, and we hear a lot about that. And we spoke about separation of duties, but in our world, I kind of refer that as separation of powers. Self-custody, the most important thing, in Rosario touched on in the last panel regarding balance sheet management. So separation of balance sheet. As a trust company, we're obligated. We have two balance sheets. One is our client balance sheet, and the second is our own operating balance sheet. So keeping non-self-custody means that your asset is not on your own balance sheet. And by being not on your own balance sheet, meaning that you cannot freely have the power to invest it whereas you please, as we've seen in FTX. So the reason why many banks, have a separate trust component is really balance sheet management, to keep their assets off and having it on a separate balance sheet. And this way, this is really transparency that we've been looking for. That's the most important thing why it's not self-custody. To me, self-custody is way beyond a hardware wallet, keeping your own keys, meaning that's your own assets. That goes way beyond that. So I think balance sheet's probably the most important thing about not self-custody. Sorry, Reggie, over to you.
No, so what technology provides is an option, right? But you got to develop a completely different set of skills, governance and separation of duties. The way you record these assets should be different. And if an institutional investor, or if an investor thinks that is core part of what their duty is, then of course, right, there are tools and money and resources that can be spent to acquire that. But the first primary question is what is the purpose of that particular investment strategy, right? So is it and I think a lot of this answers to this would stem from the purpose of the asset manager or investment management company that is doing it, and that is a point where you got to decide what do you want to do with it, right? So, but definitely the tools and technology that is available out there sort of gives you the option if you think that is the right, if it is aligned with the strategy of your investment management firm. But you got to ask yourself, right? What is the purpose that you're either managing your own money or a third-party money? Safety and security is definitely out there, but there's a bunch of regulated custodians out there that are going to offer you similar service, and that is a trade-off you need to do. And that is where I think you got to basically tie it back to the purpose of what is your firm trying to do there.
Excellent. Okay. Yeah, thanks for covering that. I think, like you said, important thing to discuss. Someone mentioned trust and confidence, and I think it's worth just touching briefly on kind of how that's rebuilt. So Phil, maybe if I can come to you for the next question on that kind of rebuilding of trust and confidence, and perhaps what can the crypto industry learn from TradFi, and especially in kind of areas such as custody of client assets?
Well, I suggest probably quite a lot they could learn, if I'm honest with you. And it's I think to Rajiv's point, it's the technology brings new capabilities, new efficiencies, new transparencies, all these nice things. But fundamentally, some of the things have to remain the same. The segregation of duties, responsibilities, the appropriate level of regulation doesn't change. And just even on the custody question, self-custody question, as a non-custodian, I was sitting there thinking, the custody business has grown up over time, offering value to their clients. That has not changed. The rationale of the custody business hasn't changed. Just because we're moving to a new digital age with new digital assets, the fundamentals of why I put assets into custody hasn't changed, be it balance sheet, be it trust or security. So again, I think the industry can learn a lot from that and build from maybe from the ground up again, with the right appropriate levels of trust and credible partners in place, with a clear segregation of duties, with transparency of those areas, and having the ability to work with partners that can help clients grow their business and partners grow their business and expand at the appropriate pace. And I think that's something that we've seen historically. I don't see it fundamentally changing, just that we have new techniques and capabilities, i.e. the technology, that can allow us to do it in maybe in a more efficient and interesting manner. The distributed finance models, I think, incredibly exciting, the way they've been developed. But actually, if we put them to use in a more traditional finance world, that is where we might see real value. And, it probably disrupts the existing traditional models, but that's probably going to happen. But it's also very interesting, but it will happen in a regulated, controlled manner. So I think that's, where we're going with that. So I think the opportunities to grow and build with a, new trust and credibility with the industry based on traditional models, I think is something that the kind of industry can take away from events over the last couple of months.
Yeah. Rajiv, as the other kind of banking representative here, what are your thoughts on that as well?
No, I think the way you got to look at it is that, primarily, again, Tuhina and I were speaking earlier today, is you got to look at this as simply a sort of a changes or transformation in how assets are represented. The custodians did exist when most of the assets were on paper, and as Vincent mentioned, right? So you got to basically look at different assets being represented differently, and we do change how we custodize things, right? So how a custodian operates changes on how the assets are represented, and that's happened over a few decades. They were in paper, then you basically move to central book entry accounting systems, then dematerialized assets, and simply the transformation is going on to what I would call as programmable assets, right? So that's primarily where it is. And in the larger scheme of things, if you take a bigger macro view, crypto is probably a minimum viable product that's representing in a new way how assets can move, how assets can be issued, and how assets can be safe kept, right? So it's a different technology and technique, but the fundamental principles of separating out where how assets are managed versus where you go out to sort of acquire them or source them, and how assets are issued, different entities have existed to sort of perform these roles, and as new technology becomes available, some of these roles can perform the same functions a lot more efficiently. Largely the roles tend to be relevant, and what the entities that are performing these roles need to adapt to is how they perform these roles and functions. There is a significant reason to be disrupted if you don't change the way you respond to what your clients need. The fundamental need for custody is not going to change, right? So at least that's what we're all probably agreeing. But as new ways of custodizing, like if you want to custody a digital asset, you got to basically get comfortable in your operating model with how do you want to manage a private key and a wallet infrastructure, and how do you want to host it. What kind of control do you want to give to the investors as well, right? So you can either own the full private key, or you can sort of own part of it. And these are the operating models that will refine over a period of time. But the fundamental need for separation of duties, I think, is going to exist. Yes, right? So when newer things come along, sometimes we'll have to learn things the harder way. And by the way, right, so in 2016, 2014 time frame, Mount Gox also happened, and that did teach us something. And there's, again, right, so we all learn, sometimes the hard way, sometimes the easy way, but it's much better to go back to the first principles and look at why are certain things done in a certain way, and that sort of addresses some of the fundamental questions sometimes we need to answer. I mean, every time something new and shiny comes along, the activities can be performed absolutely more efficiently, right? So there's no argument about it, but to think that we don't need a certain type of activity is where I think we sort of run the risk of creating problems for ourselves, I should say.
Yeah, that's brilliant. I think you answered a few questions coming from the audience there as well. But Tina, it sounds like you want to add something to that.
Yeah. I thought it was very interesting, right? In the previous session, again in this session, the question that we're saying, it comes down to the very basic root of the conversation that's been going on in the crypto space, right? We're saying, how do we bring trust back to crypto? Whereas, the fundamental conversation with crypto has been, oh, this is trustless, right? So that very fundamental conversation needs to be revisited. Like, are you really talking about an industry that's trustless? Or are we talking about trust that is only getting changed from a point from, what are you trusting? So trust is not being taken out of the system. It's just being transferred from one type of entity to another type of entity. So first thing is to recognize that very basic fundamental feature. And with that understanding, that new understanding that trust is most intrinsic, as human beings, we are born into trust. A child is born with trust that his parents are going to take care of him, right? And that fundamental human need to trust is not going to get changed because of a new technology. And once that basic understanding is had and well understood, then that the conversations would change around, why do I need a custodian? Or for that matter, why do I need a centralized servicing counterparty for any kind of thing at all? And the conversation will change to, how can I do this better than what it used to be done earlier? So just a slight point there.
And just building on that, John, I mean, just going back to traditional models, I mean, if you go back to the FX industry, and CLS was mentioned on the last panel, I mean, why did CLS come about? Because there was fundamental risk in FX settlement back in the turn of the century, and there'd been major issues with a failure on the bank and the settlement risk, and that led to CLS being created and the removal of settlement risk in foreign exchange. So these lessons have been learnt over time. So actually, we're just relearning those lessons in maybe the new markets and new assets. So it's not fundamentally new. It's just maybe we need to relearn those lessons. And for example, even today, CLS is probably now under threat for new digital assets and the ability to digitize currencies and central bank digital currencies, where we can do atomic swap of value on those currencies instantly, therefore removing the need for the CLS type of structure. So all these things change over time and develop. And I think that's just what we're seeing, you know, in the world today.
Yeah, all great thoughts. Yeah, I heard CLS mentioned a few times in that first panel. I mean, if they're tuning in today, I think they'll be very, very happy. Can we talk about the two sides of digital asset custody then? You know, banks versus, I guess you can call them kind of digital asset specialists. And can we talk about how they can or will work together in the future for the betterment of this sector? You know, is it a good thing to have both traditional and new players in the space? And Giorgia, perhaps come to you first with this one.
Sure, absolutely. I think banks and you know, players such as ourselves in the space are really due to work together in this. I do believe, and I think all of us do believe, that digital assets are here to stay, and then we are effectively witnessing one of the biggest, you know, financial revolutions that ever happened, right? So as such, we're gonna be basically standing alongside, in my opinion, you know, traditional players, of course. So working together on finding out the best way to allow you know, regular Joe to be able to have his own space, you know, and his own relationship with digital assets is actually the way to go. So we. You know, we are in conversations with a lot of these, you know, traditional players, and you know, working together with them to really, you know, have a lot of education going on, advisory, and yeah, just to answer your question, basically, you know, definitely we should both be working together.
Yeah. Anyone else want to jump in on this?
Yeah, I think you know, I'll just add a few points, right? So there'll always be, you know, I wouldn't basically say the first mover, but there will be a follow-up, right, from the traditional institutions. Is just given our cost structure and the way we do things, we need markets to be of a certain scale before we move in, and it sort of acts probably as a moat for us. You know, our hurdle rates are higher. So we need to see significant client demand. There should be more certainty. And that's what basically means that the space would be open for specialists for a while. And then, you know, and while the specialists move in and provide services, I think what organizations like ourselves will do is educate and engage ourselves in terms of understanding what the infrastructure brings through, how it is applicable, what are the implications to our business model. You know, does it mean that we use that capability to defend our existing business? You know, what kind of growth will come through, and these things, you know, will solve themselves over time. And in the short run, or even in the medium run, there's definitely potential for partnerships in this space. As an organization, I think traditional organizations need to go through that experience curve, and we move at our own scale and at our own pace. So there's definitely potential for partnerships in that space. Yeah, and they got to basically look at, and I completely agree with the observation that they're here to stay, but I don't think traditional institutions would be enamored by a specific type of asset class, but you know, I think it is about the asset representation and programmability that actually is a lot more attractive to a traditional institution, and the efficiencies it will bring, right? Of course, it will definitely give rise to new asset classes. And as things become more powered by software, right? So that's what I would call tokenization, and digital assets is infusing a lot more software into asset representation. You know, the asset universe is going to expand tremendously, right? So if you look at you know, when assets for paper probably had a couple of $1 trillion of assets worth custodying, in the dematerialized world, you basically went on to hundreds of trillions of dollars. And then maybe if you just go to digital assets, we're talking about 10,000 or more value, right? And then the pie is big enough for sort of everyone else to sort of serve the segment of customers that they need to. But there's, in the initial days, I think, you know, there will be space for specialists, I think, in this asset class as it sort of matures. And then that sort of, at least in the near term, there is definitely scope for partnerships.
Just to
Maybe I'll add.
characterize. Go
Sorry.
ahead.
Oh, okay. Yeah, I think there is definitely a correlation and a partnership that could be had between the digital asset custodians and the traditional banks. For us, we custody multiple different asset classes. And of course, our treasury for fiat is a bank. And our treasury for physical assets like gold bullion or art is likes of Brinks or Melka Mid. We use broker dealers or custodians for our equity shares, public shares. We use crypto. We work with third parties that are very credible. We work with Fireblocks. We work with Ledger. So for us, we don't try, to build our own proprietary treasury because we feel there's better people out there that can handle those technology plus their own internal controls, governance, their own regulations. So hopefully the banks will also treat a digital asset custodian like us as one of their treasuries. So in the future, banks are the most heavily regulated industry in the world. We've seen that. But crypto is such a fast, volatile maneuvering asset class. And volatile means that it could drop 10, 20, 30, 90% in a day. And banks, their biggest challenge for that is handling the reserves. How do you deal with a reserve when your asset drops by 90% in a day? So this is where I think the digital crypto custody and the banks could work together in the future.
So if I had to characterize what Rajiv had just said, right, I would say this initial wave of the first 10, 12 years is more of what I would say technologists who would say so we moved from space which was dominated by technologists to then custody being provided by people who would characterize themselves as saying we're technologists who understand finance. And so I would call this entire class as market creators. And then over like the next phase is when you would move into a space where and I think we're already getting there, where it's like we're finance people who understand technology. And this would be the space moving from market creators to market growers. And I think there is that space where we move towards where the collaboration between the two types will create what I would say financial technologists who will be able to straddle both the sides quite well. And so you definitely need different types of parties coming in to be able to grow the market over the next 10 years.
John, I was just going to say that, JP Morgan Coin is agnostic. We have an ambition to participate significantly in delivery versus payment. Now, whether that's for native digital assets or traditional assets that have been digitized or even traditional assets today, we're agnostic. What we're concerned about is that we're dealing with credible regulated partners that have good quality KYC, AML procedures in place that allows us to transact with them. That's the only criteria. The asset actually is kind of, we don't mind. It's just the other characteristics that we're concerned about. So that's just something I'd put out there. Yeah,
it's a really good point. I guess if I'm looking at time, the kind of last question I wanted to ask, which I think might be a good kind of way to wrap up this event before some closing remarks from Bosonic, is we've heard a lot of reasons about why, or a lot about why, for obvious reasons, the FTX saga has been bad for institutional adoption of crypto. I'd be keen to get everyone's thoughts on why it might be a good thing. Don't all jump in at once.
As with anything, right? So short term, I think there's going to be some pain, but as it's almost like you're picking up a new exercise, right? It's the muscle breaks. There's pain in the short run. I do think that's it is going to take everyone back to the first principles as to how and why things are done in a certain way, get to examine closely, and then basically create a solution that fits their context, right? So that is what is key, right? So I don't think we'll end up saying that there is a certain way of doing things that fits everyone, and as we all will agree that there's no silver bullet, but I think people, institutions and clients would basically re-examine things, how they are done, probably put in the right kind of controls. You can take back control, but with that particular thing comes accountability and responsibility and probably learning new skills. That's absolutely, if it's the right thing for you to do, you will do that. But I do think that the whole saga would actually work towards more sustainability of the ecosystem, right? So the infrastructure and how you want to participate in that and how do you want to go about managing it is going to be a lot more sustainable, I think.
I'm a big component of the whole blockchain technology, and I feel that with what happened with FTX is also the problem. I mean, so that's what put us into this situation is technology. FTX built a backdoor and put blinders on the whole industry, investors, having assets go through the front door and out the back without anybody taking notice. And that is really done through technology. So for this to happen, I think now the blinders and the blind spots have been really realized, where people are saying, well, you cannot be completely decentralized. There has to be some component of centralization, some regulation, some other eyes on the assets. So this kind of opens us up to saying that, okay, well, how does the two industry work together? How do we incorporate, how do we integrate regulation, proper custody into the tech, into blockchain, into crypto world? So this is, as Rajiv mentioned, this is short-term pain for a long-term gain.
So I would say that I would like to make 2 points here. The first one, alluding to what Vincent was saying, right? There is, in this industry, there are two completely separate type of players. There is decentralized protocols and applications, which have a completely different set of characteristics. And then there are centralized service providers. The problem happens when centralized service providers come garbed as decentralized players and then try to get out of the whole, the whole, I don't want to be audited, I don't need to be regulated. That's the problem. And that's when they become weapons of mass destruction, like FTX did. So I think that clarity will start to emerge. Or you adapt and hence you're publicly auditable. So that's a different thing. But here you are a centralized service provider. And if you're systemic, then these are certain things that you must do, right? And risk governance, audit, regulations type of stuff. So that's the first point. I think that's a big learning. The second thing I would say is what Philip and Rajiv have been alluding to throughout this conversation in different ways is we're going to be moving. This is going to be a definitive, I would say, a watershed moment where we will see the industry move away from a speculative phase to a utility phase. And as what Rajiv had said earlier in the day as well today, which I found very, very instructive, is that the boom bust cycles happen. And so the excess capacity that has got created in the cycle of boom is now going to get used into the utility phase. And we'll see real use cases emerge, which is like tokenization, or how do you make existing asset classes or new asset classes or new products come out with the help of this technology, and do all of this in a much more efficient and better manner. So I would think these are two really, really big benefits that we will experience as an industry medium to long term.
There are positive externalities for speculation, right? So one of that is excess capacity creation. We can all agree that there's an amount of new skill sets that are available that I think will sort of, that's a great point, Tuhina, that now we're sort of going from to a utilitarian phase wherein how can we sort of create something that is largely utilitarian, but is also useful at the same time, right? So we have always speculation, the boom cycle creates excess capacity, and the markets will find a better use for that capacity, right? Created.
Jumping in. Oh, sorry.
So if you want to, yeah, Giorgia, go ahead.
No, just real quick. One thing I wanted to say that I think, unfortunately, this might not be actually, I think, the last time we see an event like this. I think we should prepare ourselves that this is not going to be, that's it, and then regulation is going to adapt, and then, the whole industry is going to be cleaned up. I really don't think so. It was still early in the industry for this. So I think I hope that regulations will speed up, and I think the EU just today or yesterday announced that they're gonna actually trying to work much faster around MiCA, which is great. And I hope that licensed players in the market and those that they have this long-term view on digital assets and doing it right actually will come together and don't think so much about competing with each other, but thinking about working together, collaborate to build trust again and really build what traditional institution as well as any other corporates that want to have presence in digital asset space need to actually do it in safety.
Fantastic. Phil, any closing comments before we finish up?
I just said that, JP Morgan recently did something called Project Guardian with a number of others, and with other, our peers in the marketplace are working with regulators, central banks, to actually work out how we can use distributed finance in a regulatory controlled framework that works for everybody, whilst not being a free-for-all, where we still have the KYC, AML requirements in place. And we're committed to that. We're absolutely committed to that. And I think, historically, we're seen as slow and you're not moving as fast, but maybe the industry can slow down a little and kind of join in with that, because they now understand that actually it's probably the right way forward if they want to grow the business in a sustainable way and grow it going forward. So, there's a lot of effort amongst everybody on this call to make this work. And I think everybody's still committed to that. So I think that will continue. And maybe people are beginning to think that actually it's the right way to do it and buy into that approach. We've certainly seen what I might refer to a flight to quality. We've a number of inquiries we've had over the last 6 months of, growth has been exponential relative to maybe the 6 months before, where we were seen as traditional players and kind of less interesting for participants.
Well, look, thank you all for your thoughts and comments today. Extremely insightful conversation. I appreciate there's a lot of questions still in the chat coming through. Perhaps, the panelists or Bosonic can address some of those. But for now, just to say thank you all again, and we'll throw it back to Jason for some closing thoughts.
Awesome, John, as always, and panelists, your superstars. That was absolutely fantastic to watch and observe and listen to the best of TradFi and the best of crypto agree principally on some of the broad brushstrokes and come together. And just to really run through very quickly, crypto is clearly the MVP as we see it today, and the future of capital markets especially is a digital one, and building this infrastructure and building this ecosystem is a massive responsibility, and we're just in the beginning of that journey. So I think that's a big message from today. The industry does need to take steps. I think we've all seen that, from the first panel, but also from this panel. But regulation is good. Over-regulation would set us back. So we need to collaborate not only as an industry, but also with the regulators. I think the real takeaway around 2023 being hopefully a better year than 22. Hopefully that's an obvious point to make, but certainly a better version of the industry coming through this and coming out of this. POR, we all know that's flawed. It's a simple, quick answer that doesn't solve the real problems. And certainly think the headline we all totally agree on is the segregation of duty between trading and custody. And anybody with any experience in capital markets and TradFi just knows the role and the importance of a custodian. It's way more than just safekeeping of the assets. There are so many other things that go with it, regardless of how the technology of what's the asset class. It's a fundamental lesson of the last 20, 30 years of capital markets that should not be forgotten. Clearly, the need for infrastructure to solve the issues around credit risk and settlement risk and moving away, if I dare say, from DVP to PVP. The technology exists today. I came into this crypto digital asset space back in 2015 when I fell in love with blockchain and what it can achieve. We're still not really implementing that the right way. And I think that's a massive opportunity for us all to get behind and support. And clearly Bosonic is part of hopefully that proposition, part of that solution. The thing between the collaboration of TradFi and crypto, that was a key point. And then I think the one thing I would like to finish on, which came from Tahina in bundles, it came from Lars, and I think it came from a lot of the panelists in many different ways, is trusting the people in the organization and the rebuilding of trust, especially now. But I would love to combine the trust established as an industry and the industry doing the right thing the right way to rebuild that trust and establish further trust in this ecosystem, but also at the same time, the opportunity for trustless transactions, leveraging the technology. So that combination of trusting the people, trusting the organizations that are involved in this ecosystem and this build out and this opportunity, at the same time enabling trustless, verified transactions, utilizing the technology in the right way, I think is hopefully the future of the digital asset world that we're all part of today. And I would just love to thank the two panelists, the two moderators, and all of the panelists. I think you've all been superstars, so thank you very much from me. Good night.